Hello and welcome to today's episode. In this episode, we will discuss about the meaning of financial statements, financial statement analysis, and techniques of financial statement analysis. I'm Shivangi Anand and our subject expert is Dr. Arshia Hussain, teaching in the Center for Management Studies, Jamia Millia Islamia University, New Delhi. So let us start this episode with the concept of financial statement. Financial statements. All business organizations, in order to maintain the complete records of its business transactions, prepare two important statements, namely profit and loss account, also known as income statement, and balance sheet, also known as position statement, at the end of every financial year. These two statements put together are known as financial statements or final accounts. A financial statement, therefore, may be defined as a statement which provides financial information relating to an organization's economic activities in a condensed and orderly form for the guidance of the interested parties. They are the means of communicating accounting information to various users of accounts. The profit and loss account shows the net profit or loss for a given period of time. It contains the items of revenue, income, and expenditure. The balance sheet or position statement shows the financial position of an enterprise, that is, it provides information relating to assets and liabilities of a concern on a given date. The information contained in the financial statements are based on the balances of ledger accounts. The transactions are first recorded in the primary book known as journal. The journal is divided into sub-journals, also known as subsidiary books, such as cash book, purchases book, sales book, bills book, purchases returns book, sales return book, journal proper, etc. Journal helps in preparation of various accounts in ledger. The entries made in the journal are according to predefined rules of bookkeeping and accounts. The entries so recorded in the subsidiary are then transferred to ledger, which shows the classified summary of all the accounts. Ledger is thus a principal book of accounts which provides the complete analytical record of all transactions connected with each person, property, income, or expenditure. At the end of every financial year, a trial balance is prepared with a view to judge the arithmetical accuracy of the books of account. A trial balance is a statement of debit and credit balances of different types of accounts extracted from the ledger to test the arithmetical accuracy of the books. The final accounts show the ledger balances or balances as collected in the form of a trial balance in an orderly and systematic form in accordance with the requirements of the law under which the enterprise is set up. Thus, the accounting cycle, which started from journalizing the mercantile transactions, ends with the preparation of final accounts, which represent the recorded facts. The recorded facts form the basic raw materials from the construction of final accounts. Final accounts of a concern depends not only on the recorded facts, which provide objectivity, but also on the personal judgments of management and accounting. Conventions which introduce subjectivity in accounting. For a student of management accounting, it is important to understand the concepts, principles, and conventions underlying the accounting information which are presented in the form of income statement and balance sheet. Construction of financial statements, final accounts. The final accounts, that is income statement and balance sheet, are prepared to know the operating results and state of economic affairs of any concern. The joint stock companies are compulsorily required under law to maintain the records of their transactions and publish the statements for the information of the investors, creditors, and others. In case of sole proprietary concerns and partnership organizations, the construction and publication of financial statements is not compulsory. but generally the sole proprietors and partnership firms also keep proper records and prepare the profit and loss account and balance sheet, since these documents serves an important purpose. The construction of the financial statements or final accounts provides following advantages to the business organizations. The profit and loss account shows the net profit or net loss for a given period of time. The management can manage the income only when it becomes known to them through the preparation of the income statement. The operating expenses are brought into the income statement to determine the net profit. The management can know the position of administration expenses and take steps to control them if they are excessive. The figures of sales, gross profits and net profit, if compared for the last few years, show the direction of change, the knowledge of which is very important for the management. Such information is readily available from the income statement. The management can exercise better control over properties, assets and liabilities by the preparation of balance sheet, which provides an aggregate view of assets, liabilities and owner's equity. The statement of changes in financial position, which is published by some companies, is a very useful statement for managerial decision making. It reveals those changes which cannot be understood from the balance sheet. Financial statements can be produced in courts in support of owners' claims for income tax, insurance claims, etc. The lending institutions ask for the annual reports when an entrepreneur approaches them for financial accommodation. Thus, the annual accounts or annual reports facilitate the task of borrowings by an undertaking. An existing company, when raising additional capital, has to publish the information relating to the position of its capital, reserves, profit, dividends, etc. for the last few years. The financial statements provide such information to the management. Limitations of financial statements. The financial statements of an organization consist of two main statements, namely profit and loss account and balance sheet. They suffer from certain limitations. Financial statements are historical in nature, they do not reflect the future. Since the financial analyst is concerned with analysis and interpretation for formulation of future business policies, he should restructure the reports or statements in such a manner that they become useful for projections for future. The financial statement, that is profit and loss account and balance sheet, do not show qualitative changes which affect the performance of an enterprise. The annual reports do not account for such events such as change in management, strikes, changes in government policies, etc. These events affect the profitability of the enterprise. The financial analyst should therefore try to assess the impact of such qualitative changes on the profitability of the concerning enterprise. The number of parties interested in the financial statement is large and their interests differ. Thus, the annual reports cannot meet the purpose of all parties interested in them. The concept of accounting period is not technically correct. The profit and loss account is prepared for an accounting year, which is generally a period of 1 year. This gives rise to the problem of cost and income allocation. The real profit or loss can only be calculated at the end when the business is closed down. The annual accounts can best be considered as interim reports. The profit or loss figure as shown by a profit and loss account is not necessarily a correct figure. It is influenced by the personal judgment of the management regarding depreciation, stock valuation and provisions for various reserves and contingencies. The management can manipulate profit and loss figure to serve their interest. The financial analyst should see that the income has been correctly computed by following consistent accounting policies. Balance sheet is a static document showing the financial position of an enterprise on a given date. Balance sheet is prepared on the last day of a financial year. Generally, it is prepared and published very late after the close of the accounting year. The balance sheet loses much of its significance and practical utility due to a long time gap between the closing of an accounting year and the actual publication of the same. Assets shown in the balance sheet might not be shown at their fair or current values. Companies in general do not account for the impact of inflation on their fixed assets and liabilities and show them at cost values. The financial analyst should take precaution and give due recognition to the assets valuation as done by a company. Parties interested in final accounts or financial statements. Apart from the management, there are many other parties who are interested in the financial statements of public companies. The following parties directly or indirectly become interested in final accounts or financial statements of the company. Investors. Investors like shareholders are interested in knowing the earning capacity of the business and its prospects of future growth. The shareholders are interested to know the profit earning capacity and long-term solvency of the company in which they have made investments. They will also be interested in knowing the safety of their investments. The profit and loss account and balance sheet along with the director's report helps them in knowing the profitability, solvency and future prospects of the company. Debenture holders. The debenture holders are the long-term creditors who are interested in knowing the safety of their funds and the regular payment of interest by the company. Financial statements can help the debenture holders in knowing about the existing financial position and future prospects of a company. Creditors. Creditors of a company are the persons who have supplied materials on credit to the company. They are interested in knowing the short-term solvency of the company so that their claims are paid in time. The data contained in the balance sheet helps in knowing the short-term solvency of a company. Trade unions. Trade unions are interested in knowing the profits of the company. They have to keep an eye on the profits of the company in order to maximize the wages of their fellow workmen. The trade unions can know the profit position from the income statement of the company. If the bonus is linked with productivity or profits, the income statement in the hands of trade unions become a very useful document to determine the share of bonus accruing to the workers. Tax authorities. Income tax authorities are interested in knowing the profits of the business so that income tax can be imposed thereon. The tax authorities ask the tax-paying companies to submit the detailed statement of their income for the financial year. Similarly, sales tax authorities are interested in the sales and excise authorities in the production of goods. Financial statements help them in determining taxes payable by them. Researchers. Research students and academicians are also interested in the financial statements of the company. They make use of financial statements of companies to understand their growth and development. The data contained in the annual published accounts provides a good source of secondary data which are extensively used in research studies. Lending institutions. Lending institutions like banks and specialized financial institutions are interested in the financial statements of the companies to know their long-term solvency position. With the help of financial statements, they assess the long-term solvency to ascertain whether the company will be able to pay the amount of interest as and when they fall due. Government and controlling agencies. Government is interested in the financial information of the company to regulate such activities as determining taxation policy, compilation of national income, statistics, etc. Controlling agency like SEBI is interested in the financial statements of companies for exercising better control over them in order to serve and protect the interests of investors. Stock exchanges. The stock exchanges give information about companies to their members. The financial statements provide useful financial information about the listed companies to their members. Financial statement analysis. Financial statement analysis is an analysis which highlights important relationships in the financial statements. It is used to evaluate past performance operations as revealed by the financial statements. According to Leaf, financial statement analysis is an information processing system designed to provide data for decision-making models, such as the portfolio selection model, bank lending decision models, and corporate financial management models. In the words of Meyer, financial statement analysis is largely a study of relationships among the various financial factors in a business as disclosed by a single set of statements and a study of trends of these factors, as shown in a series of statements. Thus, we can say that financial statement analysis is an important means of assessing past performance and is used in forecasting and planning future performance. Objective of financial statement analysis. Financial statement analysis is important for understanding and drawing meaningful conclusions. It is a technical job which can be performed by an experienced and knowledgeable financial analyst. The main objectives of analysis of financial statement are: to know the earning capacity. The main objective of financial statement analysis is to know the earning capacity of the business organization. The future earning capacity of an organization may also be forecasted with the help of financial statements. This helps the investors in judging the profitability of a concern. To know the managerial efficiency. The analysis of financial statement helps the management in knowing the areas of efficiency and inefficiency. This is possible with the help of various financial ratios. Management can then pay attention to the areas of inefficiency and can take remedial action. To know the short and long-term solvency of the concern. Financial statement analysis helps in judging the solvency of a concern. Debenture holders and lenders, like various financial institutions, are interested in knowing long-term solvency, that is, the ability of the company to pay its principal and the amount of interest. Creditors are interested in knowing the short-term solvency of the business, that is, the ability of a firm to pay their debts as and when they become due. Inter-firm comparison. Financial statement analysis helps in making a comparative study among various firms. This is possible with the help of various financial ratios. Useful for forecasting purposes. On the basis of the past financial statement, a firm may assess its future profitability. Helps in preparing budgets. A firm may prepare various types of budgets, cash budget, sales budget, production budget, etc., on the basis of the information given in the financial statement. Techniques of analysis. There are various techniques which are used in understanding the financial statements in a comprehensive manner. The following methods are used to analyze the financial statements: horizontal analysis, vertical analysis, trend analysis, ratio analysis. Horizontal analysis. Horizontal analysis is the percentage analysis of increases and decreases in corresponding items in comparative financial statements. Horizontal analysis involves the computation of amount changes and percentage changes from the previous to the current year. The amount of each item on the most recent statement is compared with the corresponding item on one or more earlier statements. The increase or decrease in the amount of the item is then listed together with the percent of increase or decrease. When the comparison is made between two statements, the earlier statement is used as the base. If the horizontal analysis includes 3 or more statements, there are 2 alternatives in the selection of the base. First, the earliest date or period may be used as the basis for comparing all later dates or periods, or second, each statement may be compared with the immediately preceding statement. Illustration: prepare a comparative income statement from the following. Solution: comparative income statement with horizontal analysis. Vertical analysis. Vertical analysis uses percentages to show the relationship of the different parts to the total in a single statement. Vertical analysis sets a total figure in the statement equal to 100% and computes the percentage of each component of that figure. The figure to be used as 100% will be total assets or total liabilities and equity capital in the case of balance sheet, and revenue or sales in the case of profit and loss account. J India Limited income statement for the year ended December 31st, 2012. 1000 of rupees. Net sales 4,15,000, 100%. Cost of goods sold 2,90,000, 69.9. Gross profit 1,25,000, which is 30.1%. Operating expenses, selling expenses 39,500, 9.5%. Administrative expenses 49,640, 12%. Total operating expenses 89,140, 21.5%. Operating income 35,860, 8.6%. Interest expense 30,000, 0.7%. Income before income taxes 32,860, 7.9%. Income tax expense 14,100, 3.4%. Net income 18,760, 4.5%. Trend analysis. Trend analysis means analysis of general tendencies. Trend analysis is very important in interpretation of financial statements. It helps to know the trend of available financial information. Trend analysis helps in forecasting future trend. Trend analysis is important because with its long-run view, it may point to basic changes in the nature of the business. By looking at a trend in a particular ratio, one may find whether that ratio is falling, rising, or remaining relatively constant. Trend analysis uses an index number over a period of time. For index number, 1 year, the base year is equal to 100%. Other years are measured in relation to that amount. Illustration: calculate the trend percentages from the following data, taking 2002 as the base year. Ratio analysis is one of the important and widely used techniques of financial analysis. A ratio expresses relationship of one figure with any relevant figure. It is defined as one number expressed in relation to another number. An accounting ratio signifies numerical or mathematical relationship between two relevant items contained in the income statement or balance sheet. That is all for today. We will start with another topic on accounting on next episode. Till then, take care and bye.